Welcome to the deep dive. You've brought us a really interesting set of sources today, focusing on ICICI Prudential Life Insurance's first half results for FY26. But just looking at the headlines, I feel like we'd miss what's really going on underneath. This seems like much more than just a standard earnings update.
Oh, absolutely. You're spot on. We're really diving into a pretty critical moment here.
Yeah.
You've got India's largest private life insurer trying to handle two massive, almost opposing forces.
Right.
On one hand, the government is pushing this big regulatory reform, trying to make insurance more accessible. And on the other hand, the global economy is putting the brakes on, causing a real market slowdown. It's quite the situation.
So our goal here, our mission, is to get past just the profit after tax number, the PAT, and really understand the details. We need to figure out how the company is actually driving profit, looking at things like VNB and EV, and also how they're dealing with the operational headache from that big GST reform. The big question is, are they actually set up to grab this huge insurance for all opportunity the government's creating, even if their own costs are going up internally?
That's the core tension, isn't it? Balancing making insurance easy for customers to buy while still delivering value for shareholders. And yeah, it really all kicks off with the government's push for these structural changes.
Okay, let's start right there then. The big one, the GST reform. Kick in September 2025, right? Exempting individual life insurance premiums from GST. Why did they do it now? And what's the impact for, the average person looking for insurance?
Well, it seems like a very direct, very tangible step towards that big 2047 government goal of insurance for all. Before this change, premiums, especially for straightforward term plans, had GST added on top. By just removing that tax, the government instantly makes life insurance cheaper, particularly the simple retail protection stuff. So it immediately opens up the market to more people across different income levels.
So basically, they just lowered the price tag, making it easier for potentially millions more people to get covered. Fulfills a policy goal. And how did ICICI Pru react? What was their immediate move when this big change landed?
They moved fast, very decisive. They committed right away and then followed through, passing the entire GST, saving directly to their customers.
A whole benefit.
The whole thing. They didn't keep any of it back. The cost reduction went straight to the policyholders' premium.
Okay. And are people noticing, are customers actually responding to these lower premiums? Any early signs it's working?
Yeah, the early signs look pretty positive, suggests people are quite sensitive to the price drop. Our sources show the company saw an immediate jump in website visits, more leads coming in, and better conversion rates too.
Interesting.
And that pickup seems most noticeable, maybe predictably, in that retail protection space, simple term insurance.
That sounds like perfect timing for them, given their strategy has already been focusing on closing that, quote, huge protection gap in India.
Exactly right. This government reform basically validates that whole strategy, their protection pivot. The company sounds extremely optimistic now that this GST change will be the catalyst needed to really accelerate growth in retail protection, to finally start making a dent in that big underinsurance problem the country has.
Okay, so that's the positive regulatory picture. But if we step back and look at the wider market, things look a lot less rosy, don't they? The whole industry seems to have slowed right down.
Yeah, the contrast is really stark. While the rules are getting friendlier, the sector itself is wrestling with these broader economic issues, geopolitical stuff, tariffs, just a general slowdown.
Yeah.
And that showed up in the numbers. Sector-wide premium growth, they measured by RWRP, retail-weighted received premium, it grew by just 2% in the first half of FY26.
Only 2%? Wow. And wasn't it something like 21% growth the year before, same period?
Exactly. 21% down to 2%. That's a massive deceleration for the whole industry.
So that really puts the spotlight on ICI Tree's own performance, doesn't it? They basically have to find growth, smart growth, in a market that's barely expanding.
It sets the stage perfectly, yeah. It means any profit they're making has to come from, smart strategy and being efficient, not just riding a rising tide. Oh, and on a related point, we should probably mention the new IRDAI chairman, Shreyas, appointed in September 2025. That just reinforces the idea that regulators are keeping their focus on boosting insurance penetration long term.
Right. Good point. Okay, so let's dive into those financials. How did ICICI Pru actually do on the bottom line, the profit after tax, or PAT, amidst this gloomy market?
The PT growth was definitely a highlight. Impressive, actually. It jumped 26.0% compared to last year, hitting $6.01 billion. Strong result. But, for this deep dive, we need to look at where that growth came from. And the sources say it was mainly driven by higher investment income, money made on their shareholders' funds.
Ah, okay. So their investment team in treasury management basically helped cushion the blow from new business slowing down.
Yeah.
Got it. Now, let's get to maybe the most critical metric for an insurer's future health: value of new business, VNB. This tells us how profitable the policies they actually sold this half year really are.
Right. VNB, it came in at 10.49 billion, which was, well, pretty much flat. Technically down just slightly, 0.9% year on year. Now, on the surface, flat VNB when the market's slowing down, that seems okay, maybe even good. But the really interesting part is the VNB margin.
Okay, the margin, this is where it shifts from just selling more insurance to selling better, more profitable insurance, right? How did the margin go up if the total VNB was flat?
Precisely. They weren't just chasing volume, they were chasing quality profitability. The VNB margin, that's the profit they make per rupee of new premium, it improved quite a bit, by 80 basis points up to 24.5%. And that margin boost came directly from shifting the product mix successfully, selling more of the higher margin stuff, specifically more protection policies and more non-par savings plans.
Can you unpack that a bit? What does improving product level profitability mean in practice? What did they actually change?
It means tweaking the policies themselves to be more valuable long-term. So they managed to increase some multiples, meaning customers bought more coverage relative to the premium. They sold policies with longer terms, which helps keep customers longer and adds value. And they also increase rider attachment, selling those extra benefit add-ons along with the main policy. All these little improvements add up to boost that overall margin by 80 basis points.
That's clever. A smart way to defend profitability when the market's tough. What about the longer-term value metrics, like embedded value, EV, and the total assets under management, AUM?
Okay, embedded value, or EV. That grew nicely, up 9.7% year on year.
Yeah.
It actually crossed the half a trillion rupee mark, landing at 505.01 billion. And within that EV, the value of in-force business, the VIF, which is like the future profit potential baked into their existing policies that grew even faster, up 18.1% to 377.61 billion. That strong VIF growth really shows the quality and the increasing value of the business they already have on their books.
Okay, strong EV growth. But then you look at assets under management, AUM, the total pot of money they manage. That story looks very different. It only grew 0.3% year on year to 3.21 trillion. That seems, well, tiny compared to the EV growth and the PAG growth. Why such slow AUM growth?
Well, that 0.3% AUM growth definitely stands out, doesn't it? While PANE show profitability and the value already locked in, AUM growth is much more sensitive to new money coming in and market movements. That tiny 0.3% number suggests that even though their existing book is profitable, new inflows, actual cash from new customers, might be really weak because of that sector slowdown we talked about. It could also mean there were significant payouts, or maybe customers cashing out policies, which offset any growth from investment returns or new premiums. It definitely highlights how tough the competition is right now for new customer money.
That's a really important distinction. Profitability's up, the value of the existing book is up, but the actual size of the asset pool is almost stagnant. Reflects how hard it is to attract new capital right now. On a more positive note, though, regarding the AUM, they do have... What about the quality? How safe are those assets?
Oh, extremely prudent there. Very safe. 96.2% of their fixed income investments are in government bonds or top-rated AAA instruments. And crucially, they've apparently never had a non-performing asset, an NPA, since they started. 0 NPAs. That tells you the capital they hold is managed very, very conservatively.
Okay, let's swing back to strategy and how they're executing it. The product mix, we know the big push is on protection. How successful has that pivot been in terms of numbers?
It seems to be delivering, yeah. Solid results. Total protection premium measured in APE, annualized premium equivalent, that grew 6.7% year on year. Even better, the retail protection APE Zero policies sold to individuals that grew faster, 10.8%, reaching 3.09 billion.
But the real measure of how much life cover they're actually getting out there is the new business sum assured, the NBSA, right? That's the total amount of life cover sold. And that number jumped quite a bit.
It did. That's the headline number if you're thinking about market penetration and closing that protection gap. NBSA shot up 19.3% year on year, hitting 6.77 trillion. That's pretty solid evidence that the government making insurance more affordable, plus the company's focus, is leading to customers buying significantly more actual life cover.
What about the savings side of the business? We heard the non-par products help the margin, but how did they do in terms of volume?
The non-linked savings business actually grew quite strongly, 15.6%. And that makes perfect sense in the current climate, doesn't it? With interest rates expected to fall, customers are keen on non-par products because they let you lock in today's relatively high yields for the long term. Gives people certainty. So it's a very attractive product right now.
Makes sense. So what about the other side of savings, the market-linked products? Unit-linked insurance plans or ULIs?
Ah, the linked business. That actually declined, down 10.7% year on year. Now, management points out it's being compared against a really high growth number from the previous year, which is fair, statistically true, but still, a decline like that suggests maybe some volatility in their growth. Linked products depend more on market sentiment, so it could be investors less keen on risk right now, or maybe competition in that space got tougher, or just, customers temporarily preferring the safety of non-link.
Okay. And how are they selling all these different products? What's the channel mix look like? Are they relying more on banks or their own agents or other partners?
It's a real mix, which actually highlights how much they rely on being diversified. Their own channels, the agency force and direct sales, they saw a pretty big drop, down 18%. But that seems mostly tied to selling fewer of those ULPs and annuities compared to the high base last year, which we just talked about.
Right.
And bank assurance, killing through banks.
Bank assurance was almost flat, held steady, still brings in about 30% of their new business premium, their APE. So stable. The real growth drivers seem to have been their other partnerships. The partnership distribution channel grew nearly 15%, and the group business channel grew almost 20%.
That diversification seems key then. If one channel slows down because of its product mix or market conditions, the others can hopefully pick up some of the slack. Keeps the overall sales engine running.
Exactly. And their network is just huge. What is it? Over 245,000 agents, 50 bank partners, more than 1,400 other non-bank partners. That diverse setup is designed precisely to handle the kind of channel-specific ups and downs we're seeing.
Okay, let's move into section 4 now. The internal machinery. Those better VNB margins didn't just magically appear. They were clearly supported by some serious gains in operational efficiency.
Absolutely. The cost improvements look really significant. Seems like a big factor in boosting profitability. The overall cost-to-premium ratio, down 280 basis points compared to last year, landed at 19.2%.
That's a massive reduction. 2.8 percentage points. How did they actually achieve that?
Seems like it involved some pretty deep cost-cutting efforts, streamlining how they work, using more tech, and crucially, getting their cost structure better aligned with that shift towards selling higher-margin products. And just to emphasize that point, the cost ratio specifically for their main savings business dropped by the same huge amount, 280 basis points, down to just 12.7%. That efficiency must have provided a real financial cushion.
And the basic health metrics. Still looking solid. Solvency claims.
Yeah, very robust. Solvency ratio is way up at 213.2%, well clear of the 150% needed by regulators. Claims settlement ratio is excellent, 99.3%, and they're paying claims fast average of 1.1 days for the straightforward ones. Plus, their 13th month persistency, that measure of how many customers stick around after the first year, is strong at 85.3%. So it looks like they're selling good quality business that lasts.
Okay, right. Let's tackle the elephant in the room, operationally speaking. The other side of that GST exemption coin. Customers get lower prices, which is great.
Yeah.
But the company, now that the premiums are GST exempt, they lose the ability to claim back the GST they pay on their own expenses. The input tax credit, or ITC. What's the impact of losing that ITC?
Yeah, this is a big operational challenge, the cost shock. Losing that ITC, especially on their huge existing book of policies, means, as they put it, an increase in cost of doing insurance business. It's a real hit to their expenses. Management actually put a number on it. They estimate it knocks about 1% off their long-term embedded value.
1% of EV. That's not insignificant. A tangible hit to shareholder value. They can't just ignore that. So how are they planning to, offset that cost increase without taking back the price cut they gave customers?
Well, it sounds like the answer lies in some pretty delicate, complex internal talks. Because their internal cost of acquiring business has gone up, management is now focused on renegotiating commission structures, talking to their massive network of distributors and partners.
Trying to find a middle path, as the sources put it. What makes that negotiation so difficult?
Well, they have to cut costs somehow to make up for the lost ITC, but they absolutely cannot afford to upset the partners, the agents, and banks who actually sell their policies. It's a balancing act. They're trying to structure it so the distributors can still earn the same total amount of commission in rupees. Their absolute earnings don't fall, while the company manages to lower its overall commission expense percentage to counter that 1% EV impact.
That sounds tricky. Needs real finesse. If distributors feel like they're being squeezed, that could really slow down sales, couldn't it?
You'd think so. They must be expecting some friction there.
They definitely acknowledge it's a work in progress,
Yeah.
very much ongoing. When they were asked about potential turbulence with distributors, management kind of framed it as an unavoidable discussion. Something needed because everyone knows the cost of doing business just went up. It sounds like it'll probably take a few quarters for these new commission deals to get sorted out across all their different channels. That negotiation phase is absolutely critical right now.
And just one final point on their financial strength. They seem confident enough to deal with some existing debt.
That's right. They mentioned plans to exercise the first call option on some subordinated debt, about $12 billion worth, that they raised back in 2020. Doing that signals they're comfortable with their capital position and confident that even after paying that back, their solvency ratio will stay well above the required level.
Okay, wow. This has been a really complex deep dive. It paints a picture of a company doing really well on internal stuff like strong PAT growth, strategically boosting VNB margins through product mix and efficiency, all while dealing with two massive external forces pushing in different directions.
Yeah, the main takeaway for me is how well they executed that shift towards more profitable products, particularly protection. And backing that up with really impressive cost control, they seem to be genuinely capturing the opportunity that the GST change created, at least from the customer's perspective.
So wrapping this up for our listeners,
Yeah.
what's the bottom line? The GST reform is clearly working as intended, right? Making insurance cheaper, boosting interest, especially in retail protection. The market opportunity is real.
Absolutely. The opportunity is clear. So the provocative thought maybe is this. It seems like the company has handled the external challenge, making insurance affordable, and the internal challenge becoming more efficient. Their success going forward now seems to hinge completely on, well, management's skill in handling the organizational challenge. Can they actually pull off these super sensitive commission renegotiations? Can they offset that 1% EV hit from the lost tax credits without causing major lasting disruption, that turbulence in their crucial sales channels? Getting that right seems like the single biggest factor that will determine if they could turn this huge market opportunity into steady, profitable growth in the long run.
So the next 6 months or so sound like they'll be all about internal diplomacy and negotiation. Really fascinating. Thanks for walking us through all those layers.
My pleasure. Always interesting to dig into the details.
That was The Deep Dive. Join us again soon for more insights.